Support for Short Stops is presented by the Caylum Trading Institute. Check out our website at www.cayluminstitute.com. On today's episode.
Guys, we've been saying this a long time. I think more than 10 months running already. But I think this is really an opportunity to buy, assuming that you still have cash.
That is true also.
Call it what you want. A game, an experiment, a gamble. But stock trading in the global financial markets to us is a business. Every day you're surrounded by the noise. Buy, sell, hold, buy more. And we're going to quiet it down and filter out the best trading strategies, tips, and stock picks. You want information on how to find your next bagger or home run? You'll find it right here on Short Stops.
Ladies and gentlemen, welcome to episode number 25. We made it this far. And the market has been in a roller coaster over the last few months. So I had Jason come here again to give you guys a better perspective on what to do about the market. And before we get into the topic of discussion, I'd just like to share to you guys, last time he was here, we mentioned that inflation was actually the biggest concern. And the worst case scenario that we actually talked about was if inflation hit 6%. Last month we hit 6.4. Today we hit 6.7 as of September. And so a lot of stuff that we were always concerned about is now starting to play out. So our plan here today is to give you guys a better update so that we can start finding ways to make money soon enough. So ladies and gentlemen, please welcome Mr. Jason Mariposa.
Okay, so how do we begin this? There's so much to discuss.
I mean, before anything else, ano ba yung inflation yan?
Okay,
So,
okay. It's okay. There's so much misinformation out there, of course. But if you look at if you take out an economics book, there are two sources of inflation. One is cost push, and the other is demand pull. Okay, so the first one, as the name suggests, it's all about costs. So there are three main components. It's oil prices, it's the cost of production, and three, it's the currency or the cost of imports. So if you check out all three are rising right now, right? So oil prices are up like more than 68% year on year. And if you look at food prices, it's the biggest driver of inflation right now. I think it's because of all those storms, the bad weather in the past few months. So we had all these food shortages. If you look at the other items, it's also rising, like wages already rising already. And the second is demand pull. This is all about spending. So in the past few years, the economy has really been booming. Like if you check out credit growth versus nominal GDP growth, credit growth has been growing at double nominal GDP for the past 7 years. So it means that we're spending a lot of money, and that's gonna lead to inflation one time or another. Yeah, so it's like we're being hit on all sides in terms of inflation.
Okay. But I mean, the central bank keeps on reiterating that it's just a one-time event. It's peaked already, and they keep on, like in the last few months, they keep on saying that it already peaked at 5, now it's peaking at 6.4, now they're saying it's peaked again at 6.7. And they expect like inflation to already temper down and see this as a one-time thing. What's your thoughts?
Well, I can't really blame them, right? Who knew that oil was going to continue going up? Or who knew that there was going to be bad weather second quarter that would create a lot of these food shortages? But regardless of that, I think what's the problem is that the market thinks that the BSP has been complacent in trying to control inflation. So parang tingin kasi ng market, they're already reactive rather than really trying to anticipate these things. No? Plus, you have all the volatility in emerging markets pa. So that's really creating another reason to be scared for the market. The problem here is that because of this lack of confidence in the BSP, now people are expecting inflation to rise going forward. It's called inflation expectations. Now sometimes it can be self-fulfilling in that if people think that inflation is going to rise, people are going to raise prices. Like if you go to Starbucks, they raise prices. If you go to Jollibee, they raise prices already. It's because people expect inflation to continue going forward. Now, this is going to be harder to stop for the BSP. It's called the second round effects of inflation, which we think is going to stay here for the next few months, at least.
So what you're saying is that since umakyat na yung mga presyo ng mga vegetables, siling labuyo, 1,200 per kilo, what you're saying is that now we're going to see a second round because from these ingredients, from these costs, now it's going to be done to pass on to the consumer.
Yeah, it's the second round effect.
Okay.
Yeah.
Kasama na rin dito yung mga wages increases.
Yeah.
So, I mean, at the end of the day, is this temporary in your opinion? And is it something that can be easily addressed?
It's really nothing to panic about it, I think. So a lot of these things are temporary, but of course there are some things that are persistent already. It's because our economy's been booming so much. We're spending a lot of money. And because of that, there's going to be a certain amount of inflation that's going to remain. What's happening now is that the BSP has to act to raise interest rates, and for the government maybe to start importing rice. Yeah. And then of course you have this.
So there's only so much. There's only so much that the BSP can do also in the monetary policy.
Yeah. Like oil prices out of their control, right?
Or what about sugar imports, rice imports?
Yeah. So on that front, it's not really a problem.
Okay. So what's gonna happen is that with the second round effects of inflation, baka tumagal lang.
Yeah. So it might take more time before the inflation pressure dies down.
Okay. So it's not immediate, what you're saying.
Yeah.
Okay. Relating this all back to the market, and given that the markets have gone down a lot, in your opinion, what are your biggest concerns right now?
Okay, so the past 3 months, inflation has been surprising to the upside, and I think now the market is finally paying attention. So if you look at the ones most sensitive to inflation is of course the bond market. So and lately the bond market has been selling off like crazy. Like if you look at the bond yields, like the 10-year is now 7.68%, the 5 years 7.6, 2 year is at 6.17%.
So for somebody just entering the market, what does the bond market have to do with the equity market?
Well, of course, like a few years ago, the 10-year was at 4%, now it's at 7.68%. So like for a lot of people, it's really a no-brainer to start moving money in the bond market. So what happens is that stock valuations go down. So like if before, what you would consider 17 times P would be a fair value for stocks, now that would be different going forward, especially if rates continue to stay high.
Okay. Was it a concern that interest rates went up too much in a short amount of time?
Yes, of course. The thing, if prices move too fast, nobody expects it. So it really creates a lot of volatility in the stock market.
Has these inflation concerns already been priced in?
So when we're talking about the market, it's all about perception versus reality, right? So that's what creates the opportunity. So I think the perception now is that inflation is getting out of control. And we're seeing that in the way the bond market is reacting, right? I think if you ask me, that I think a lot of it already is in the price. Right? The market's gone down like 17% year to date and 22% from the all-time high. There's like $1.6 billion of foreign outflows already. But if you ask me if the worst case scenario has been priced in, I don't think so.
Okay, so I mean, at the worst case scenario, at what level should people start closing their eyes and start buying?
Because when I look at valuations, right? So if we assume that the 10-year is going to hold at 6.5 to between 6 and 7 for the next few years, then the fair value for this year is maybe around 7.3 to 7.5 only, and maybe next year 8.3. So from that perspective, prices aren't dirt cheap yet.
Okay.
Right? Maybe they're unfairly valued. So in that way, I don't think the worst case is priced in.
Okay, so what you're saying is that since it's fairly valued today, your upside is also limited.
Yeah, assuming that interest rates stay high, which I think they will. The question is really just how high. So my number is really around 6.6. For me, it's a simple calculation.
So it means like a close your eyes type of price, right? 6,600.
Yeah, I think that's already enough margin of safety versus what's the target price could be.
Okay.
Because I mean, at the end of the day, who knows how low can it go, right?
And if you look at foreign selling, it's foreign selling every day. Liquidities have dried up. In fact, if you look at the PSC for the last few weeks, they've been trading at a 3.5-4 billion range in everyday traded. How is this a concern also for traders, especially in this type of market environment?
First, on the negative side, so you say that the market's oversold. The market's gone down like 20-something%. Valuations are not expensive, but we are the buyers, So that's a concern because liquidity is so small. Where's the people, right? So if you look at the bond market right now, fixed income yields are so high. So I think the liquidity is being sucked from the stock markets going to the bond market. So in that aspect, it's a concern, right? So on the positive end of a dry market is that it can create irrational selling, because it's very easy to push prices down when nobody's participating in the market. And in that way, it could create a lot of opportunities soon, I think.
And in fact, we've seen some stocks being sold down like crazy just because of absence of buyer, such as Security Bank, right? I mean, if you look at it, it's just going down every single day without any participation coming from, or any strong buying actually coming in.
So you're going to see a lot of these cases like Security Bank. Like you're seeing it in CHP, you're seeing it in SCC. And if you look at the large caps, like the index heavyweights, they're also starting to break down already. So if you ask me, the end is near. I mean, the
end is near. Come on.
I mean, for this market correction, I think the end is near.
Okay, okay.
You know, because you're seeing all those index heavyweights already breaking down.
Okay, okay.
Like your AC, Yalanan, SMS, and Prime, JFC, Meralco. Like if you combine all those stocks, they're like more than 50% for the index.
Okay, so what type of attitude are you having though? Are you being more looking for opportunity to be buying, or are you also selling through this panic? What would you advise somebody?
This is where the money's made, right? When everyone's negative, right? So you should be looking to buy, assuming that you still have cash.
That is true also. What's the valuation at 6,600?
If the market goes to 6.6, the valuation should be 15.1 times P for this year and 13.8 times for next year. I think that's really dirt cheap. I mean, even if you assume that interest rates are going to stay at 7 to 8% for the foreseeable future.
That's what's good. And if you remove, let's say, like the heavyweights from the index, it's probably a lot cheaper than 13.3 times for next year, right?
Yeah, I think we computed that before. X the index heavyweights, I think it's 20% discount.
So just to recap, I think Jason mentioned a lot of important points, especially when it comes to expectations going forward. We're looking at 6,600 with a PE of 13.3 times in fiscal year 2019. We think that inflation might be a little prolonged, especially with a second round of inflation effects kicking in with just basically like your Starbucks raising 10 pesos on my short Americano. We talked about how liquidity can be an opportunity also for buying, because we might see irrational selling start kicking in because of lack of liquidity.
Guys, we've been saying this a long time. I think more than 10 months running already. But I think this is really an opportunity to buy. Guys, there's no systemic risk in the country. I don't think there's going to be a debt crisis or whatever. Right? In fact, these are signs of a healthy economy. You know, the inflation momentum is going higher, but it just has to be controlled by the BSP.
And just to quote Jason Mariposa from episode number 17, it's always better to be late than to be early. Good luck, guys.
Good luck, guys.